Good morning, students. Welcome to the revisionary classes on M&A, startup finance, and value at risk. So this is a live session in which you can ask questions, and we will also do the revision of the topics. So let us start with the first topic of today, which is M&A, mergers and acquisitions, and corporate restructuring. So what I will do is I will just take through the flow of the revision that we have covered in the detailed sessions, in the previous detailed sessions. And if you have any queries, then again, I would say that please do let us know. We will answer them. So we started, first of all, analyzing what are the different types of M&A, which is mergers and acquisitions, before we actually got into the practical problems. So we said that there are four categories of M&A. First one is that there are two different companies called A and B gets merged into A with the effect of B having dissolved. So B has lost its identity. B is wound up. And hence now the only company which is remaining is A Limited. And the business, the assets, the liabilities, and even the employees, everything of B gets transferred to A. And A, in return of that, will give consideration to B's shareholders, which are the owners of the B Limited. This is what case number one is. And this is most common case seen in the practical life as well as the topic that we have. Then case two is also one of the mergers and acquisition, is also one form of the mergers and acquisition in which A Limited will acquire a majority stake. Why majority stake? Because if A Limited is acquiring a majority stake, then only A Limited is able to control the activities of B Limited. And hence there is a holding subsidiary relationship. So A Limited acquires ownership stake, majority stake by whatever name you want to call in B Limited. And this is also one form of mergers and acquisitions. So if you see students, mergers and acquisitions, correct? So merger is merging, which is case number A. And acquisition is acquiring, which is case number 2, correct? And in this case, after acquisition, the subsidiary will continue. It's not essentially that the subsidiary will dissolve. Kaushiki is saying video not starting on BOS knowledge portal, BOS live error showing. Kaushiki, what I would say is request you to restart or re-log in because no other student is asking the same. So in case number 2, we said that only through acquisition, there is one form of M&A. And the B Limited's identity will continue. Okay, now let's go to case number 3. Now, case number 3, we discussed, okay. Good morning, Yudu. Kaushiki saying, since the same I'm hearing you from YouTube. Okay, no worries, Kaushiki. Then case number 3 is we took one example where we said that a company, okay, Namrita is also saying BOS portal not working. Technical team, maybe can you check once? Because the students are saying that the BOS portal is not working. Ashokji, shall I pause once? Namrata Kaushiki. Now Janvi saying BOS portal is working. And Yudu is also saying it's working for me, sir. So I think there are mixed people. So what I'll do is I'll continue because for some it is working. For those whose it is not working, I request you to please relog in and again connect back. Okay. Meanwhile, you continue seeing on the YouTube. So let's continue, students. Now, case 3, A Limited, we said that it has two businesses, business 1 and business 2. And since both the businesses were smaller at some point of stage earlier, now they have grown. The company has decided to form a new company called B Limited and transfer this business to B Limited. This is also one kind of a merger and acquisition, which is termed as demerger. In this case, we are actually delinking or demerging one business to the another business. Okay, students. Then case number 4, we said that both A and B gets merged, but they will form a new company, which is altogether called as C Limited. This is also one kind of a merger and acquisition. The reason why we covered these different cases is just to bring a thought into our mind that what are the different kinds of mergers and acquisitions. And again, the list is not restricted to here till case number 4. It can go on. There will be different types of permutations and combinations possible in this. And our workings or our, the way we approach the question will depend on the different cases that we discussed. Okay. Yes. So we took the first case beyond and then we elaborated in detail. So we said that this is case number 1, A Limited and B Limited. There are two companies. B Limited is getting dissolved and simultaneously getting merged into A Limited. Correct? Now, A Limited will also have to pay some purchase consideration. Purchase consideration is the compensation to B Limited's owners, or let's say the shareholders of B Limited, for acquiring B Limited as a whole. Sorry, Ashokji. Got it. Got it. Got it. मैं अभी हो गया. I think Namrata and Kaushiki, both of you are okay, right? Now it is working for both of you. Perfect. So thank you, technical team, and thank you, students. Okay. Now let us continue. So A, as we were discussing, that A will have to discharge some purchase consideration, which is actually the compensation for acquiring the business altogether. And there can again be multiple forms of how a purchase consideration would look like. The first form will be equity shares. In the form of equity shares. Of whose? Of A Limited, because A Limited is the surviving company. A Limited will continue. B Limited is anyway which was getting dissolved. So A Limited's shares will be issued to the shareholders of B Limited. Okay. Then second way can be, rather than issuing equity shares, the payment can happen in the form of cash. Here in form of cash, we don't mean hard cash, but it can be in the form of bank transfer, wire transfer, anything. But the intent is that the outflow of resources in the form of cash and bank balances. So the cash payment, again, it will happen to whom? To the shareholders of B Limited, because B Limited is not there at all. So ultimately, it will be paid to the shareholders of B Limited. Then the third option can be mix of one or two. It can be 50%, let's say, first option, another 50% can be second option. Now, a very peculiar question that arises in the way you settle the purchase consideration, either point number one or point number two or point number three is, first of all, what is the right metrics? For example, in equity shares, what is the right swap ratio? By swap ratio, we mean for how many shares of B Limited, how many shares of A Limited will be issued. Correct? What is the proportion? What is the ratio? What is the swap ratio? Let's say we say that 4:5. And we'll come to it how we will estimate it. But for example, it is 4:5, then it will mean that 4 shares of A Limited will be issued against 5 shares of B Limited. So if a shareholder is holding 50,000 shares of B Limited, he or she will get 40,000 equity shares of A Limited. Okay, I hope this is clear. So there is a complete mechanics how we arrive at this swap ratio. We will study that. Then value for cash payment. How are we deriving that? What is the right value to be assigned for those cash payments? Because B Limited shareholders will demand a higher value, and A Limited will also be not willing to pay a higher value. They will be willing to pay a lower value. Correct? This is a negotiation. So B Limited will say, okay, we will demand 1,000 crore. A Limited will say, no, we can give you only 500 crore. So somewhere they will come in between and negotiate up to 700 or 800 crore. How will that be arrived? What is the method for that? Because it will be different from the perspective of buyer and different from the perspective of seller. And mix of 1 and 2 will also carry the same questions from 1 and 2. So for the entire topic, we have actually 4 major points. One is to estimate the A Limited's equity, or let's say equity value, or let's say the equity share price, whichever way you want to say. A Limited and B Limited, I have only taken 2 companies, right? Similarly, B Limited's also equity value, share price, or whatever you can say. Then third comes the swap ratio. The swap ratio will also be determined, and we will study that again. And then the last point is the post-merger analysis. Now you are also expected to do the post-merger analysis in the form that how does the merger, after that merger, the things have phased out. Whether the financial KPIs have improved, or they have downgraded, or they have remained same. And in this entire discussion, we have assumed that A Limited is an acquirer company and B Limited is a target company. That means B Limited is getting merged, or let's say B Limited is getting acquired. Okay, students? Perfect. Now let's come to the real game. So the PE ratio, we all know from our knowledge on portfolio and knowledge on other things, PE ratio is simply price divided by earnings, which is market price per share divided by the earnings per share. And we can also say that total market value divided by the total earnings. Total market value is what? Come on, students, tell me what is the name of total market value? What technical term we use for the total market value? Is equal to what? Students, please do respond. We will try to make this a very interactive session. By what other name you call market value? The total market value. Yes. Janvi is saying capitalized value. Kaushiki is saying fair value. Okay, good attempt, students. We say this as a market capitalization. We say market cap, right? What is the market capitalization? That means the overall market value divided by the total earnings. So sometimes in the question, if it gives you market capitalization, so treat it as same. Very good. Yedu is saying market cap. Namrita is saying market cap. Namrita is saying value of business. Very good, students. Market cap is the right word. And how does market cap gets arrived as is M cap is equal to MPS, market price per share, multiplied by the number of shares that are floating in the market. Correct? We will study this. Then comes the swap ratio. Now, students, there are different bases on which swap ratio can be agreed and it can be calculated. So the first and the foremost base, or let's say the most used case base, is the MPS base, which is market price per share of the target company divided by market price per share of the acquirer company, which is A Limited. For example, the market price of B Limited is actually, let's say, 5 rupees. And the market price of A Limited is actually 10 rupees. So for every 2 shares of B Limited, 1 share of A Limited will be issued, correct? 0.5 is to 1, or we can say 1 is to 2, whichever way you want to say. Okay, students, because if I'm going to swap something or if I'm going to barter something, at least I want to make sure that the overall kitty size remains same. So if I'm getting something which has a real worth or the market value of rupees 5 and I'm giving something for which the real worth or market value is rupees 10, so I will expect 2 units of the same and I will pay 1 unit from myself, and hence the swap ratio is 1:2. The formula is also saying the same thing. MPS of B Limited divided by MPS of A Limited. Now please don't get it confused for B Limited and A Limited. Please keep only one thing in mind. Whichever company is getting acquired, the target company always has to come in numerator. And the acquiring company who is issuing the equity shares or who is discharging the purchase consideration will come in denominator. Now, students, the complexity of mergers and acquisitions in practical life as well as in some of the questions is such that we are sometimes not able to identify which company is acquiring company and which company is a target company, or let's say transferor/transferee. So always keep one thing in mind, that whichever company is paying the purchase consideration, that one fact would be very clear. Correct. So whichever company is issuing the equity shares for discharging the purchase consideration, or whichever company is paying cash for discharging the purchase consideration, will always be the acquiring company, which is similar to A Limited. Okay. Yes, Kaushiki is referring to reverse acquisition. We will come to that, Kaushiki, because in reverse acquisition, the things will get reversed. We will discuss that. Then second, again, the same part here is basis the EPS, earnings based. Now, if you see some of the companies say that we are least bothered with what is the market price going on into the market, because that is reflective of lot of things which are not fundamentally true for the company. Correct, because in the share market, the technical part is playing a higher role. However, EPS is something that is more fundamental to the company, because the earnings capacity of the company is derived from the EPS. And EPS is what we see the potential in. And hence, we will base our swap ratio on earnings. So the earnings per share of B Limited again divided by the earnings per share of A Limited, the same formula. Then some of the companies says that we will go with purely the book value. We will also not see the MPS, EPS. Sorry. We will also not see the MPS or EPS. We will directly see what is the book value per share. So they will follow this approach. Then the last one, which is more relevant for the banks, is sometimes they will say that whichever bank is having a higher NPA, that bank will be valued lesser. Correct, because presence of NPA, non-performing asset, in a bank is not a good sign. And hence, if NPAs are higher, the value assigned to that would be lower. Correct? So the formula in this case gets reversed. The gross NPA of A Limited, which is the acquiring company, divided by the gross NPA of B Limited. Okay, students. So these are the 4 ways to calculate a swap ratio. Sometimes the swap ratio would be given in the question also. But sometimes the question might ask us to calculate the swap ratio. Okay, students? Okay, one more point. It's not likely that sometimes the company will use any one of them independently. The company may also use mix of one or two. Let's say they will say 50% will be basis market price, 50% will be basis earnings. A mix of all these 4 can also be used for arriving at a final swap ratio. Okay, students? Yeah, sorry. Now let's come to EPS, because we said that one of the method of swap ratio is actually dependent on EPS. Now EPS, all of you are champions. You already know how to calculate EPS. EPS is equal to profits attributable to equity shareholders divided by number of equity shares. Very simple. Whatever profit we are attributing for the purposes of equity shareholders, that you have to take. We are not saying you have to take PAT. PAT is not to be taken, which is profit after tax. No, we will take out of that profit after tax what is attributable to the equity shareholders divided by the number of shares. Market value, we have already discussed. We also call it as market capitalization. Okay, students, then market price. Now, since P ratio is equal to price divided by earnings, so if we have to calculate price, it will simply be P ratio multiplied by earnings. Correct? Easy and simple, students. Or for EPS also, we have put one more formula, which is PAT minus preference shares dividend divided by the number of equity shares. Okay. These are some of the general discussions that we did, because all these are used in the questions somewhere or the other. But this is the knowledge that you're already carrying from your previous sessions. Now, Namrita is asking, please repeat fourth method. Okay, Namrita, let me repeat. So, Namrita, the fourth one we have taken because if there is a situation of merger of banks, then what will happen? So hear me out. If let's say there are two banks, okay. Now, while the deal is happening between these banks, they will also try to base their swap ratios not only on the earnings, not only on their book value, not only on their market price, but they will also want to see what is the NPA, because non-performing assets forms major part of their assets, which will either give them income or which will not give them any income. Correct? Because they are the differentiating ones. Because on non-performing assets, they can expect one, a credit loss, second, no income being generated. Okay. So let's say this is 10% and this is, let's say, 20%. And A Limited is trying to acquire B Limited, and both of them are banks. Now, what will happen essentially is that this, if you use the previous swap ratio, 20% divided by 10%, which is, let's say, B Limited divided by A Limited. Now, in such a case, what will happen? Despite of the lower A Limited's NPAs, the A Limited will end up paying 2 times. Correct? It will be 2:1, which will be a wrong amount. Because what is 2:1 saying? 2 shares of A Limited for 1 share of B Limited. So this is going to be wrong. The correct way is 10% divided by 20% for every 1 share. Sorry, 1 share of A Limited for every 2 share of B Limited. Okay, so this is the right method, and hence we say that A Limited will be in the numerator and B Limited will be in the denominator whenever the question specifies on NPA. There is one question in our assignment which also have this type of problem. Okay. Now coming back, EPS after merger. Now, students, we have seen EPS before merger for both the companies, respectively, the formula remains same. EPS after merger or the post EPS merger, we have taken 2 different examples. The first example is on the shares settlement. Now, let's say the purchase consideration is getting settled. Is getting settled in the form of shares. In that case, what will happen? We will take first of all PAT of A, then PAT of B. Here we are assuming PAT is equal to the profits attributable to equity shareholders. Okay, there is no preference dividend. Plus in that we will add the synergy gain. That we will divide by the equity shares of A Limited, and we will also add the fresh equity share that we have issued to the shareholders of B Limited. These are the fresh issue. Correct, students? Because post merger, I already had, let's say, 10,000 shares, but I further issued 2,000 shares to the shareholders of B Limited. So that means my total division base becomes 12,000 shares. and part of A we will add to the part of B, and if there is any synergy gain, that also we will add. Now the synergy gain I will discuss later on. Okay, what is the synergy gain and how do we perceive this? The second scenario is through payment of cash. The first we discussed, it is through share settlement. The second is through payment of cash. Now, by cash, I mean that there is some outflow of resources that is happening. So PAT A plus PAT B plus energy gain, this is same. But we are paying cash on that we could have already earned some amount. So that return percentage we will multiply and make it post-tax, 1 minus tax. Correct? Because that return post-tax, whatever we could have earned on that cash, for example, that cash we would have invested in some of the securities. And those securities were giving us 10% return. Out of that 20% tax we were paying, that means essentially 8% on the idle cash, or let's say on the cash invested we were earning. So that amount we will reduce from here because the same earnings now will not be available. Correct? On those. So then hence we will reduce this divided by the total number of shares of A Limited. Okay, students? Are there any questions till now which you have? Okay, let's carry on. Yes, Namrata, this is an opportunity cost. You're right. This cash that we have paid, on that we would have earned some return, on that we have lost the opportunity cost. We will come to the synergy discussion later on. Okay, I will discuss in detail about the synergy. Now, since we have understood how to calculate EPS post merger, can we also try to calculate the impact on EPS, or let's say the effect on EPS post merger? Yes. So how it will be calculated for the acquirer company, or let's say the company who is acquiring A Limited in our case, the post merger EPS we will simply take and reduce from it the pre merger EPS. 1:1, right? Because earlier also A Limited was, the shares were comparable, and now also the A Limited shares are comparable because they've issued fresh shares. That's why. So the net impact on the acquirer company is this much. But for B Limited, the situation changes because post merger EPS of A Limited we will take, because after merger B Limited is not there. Only the B Limited's business has gone into A Limited, correct? So we have to take the A Limited's EPS, but that we have to adjust for the swap ratio to arrive at the equivalent amount that would have been for B Limited post merger. And then we will reduce the pre-merger EPS of B Limited and arrive at the net impact on the target company's share holders. Okay, I hope this is clear. So students, don't forget to adjust this for swap ratio, because one share of A Limited post merger is not comparable with one share of B Limited pre-merger. So this is the point that all of you need to remember. One share post merger of A Limited is not comparable to 1 share of pre-merger B Limited. Correct? Because of swap ratio. We can say because of swap ratio. And if you want to compare it now, so you adjust the A Limited's post-merger share with the swap ratio, and then you compare it. Like this, we have done. Okay, students? Now, sometimes the question will also ask you to calculate the value of acquisition. So whenever we are asked or we are required to calculate the value of acquisition, please always base that discussion from the A Limited's perspective, the company who has acquired the business. And how it will be computed? It is very simple. Value of the merged entity, the overall market capitalization post-merger, minus value of the acquiring company before merger. The value of the same company before merger was how much? The current value minus the post-merger value. Simple. That will give us the value of acquisition. That means the increase in the market capitalization because of the entire merger. How much it has happened? That incremental value is called as the value of acquisition. And this is always calculated from the A Limited's perspective. Okay, students? So any questions till now? Okay. So let me write down one part here. Let's say A Limited and B Limited. A Limited is actually having, let's say, 2000 crores. This is market cap. Okay, students. And B Limited is having 500 crore as market cap. Okay. Now the news in the market is that both of them are merging. Sorry, B Limited is getting merged into A Limited. As a consequence of which, the A Limited's market cap has become 1900 crore. It can happen, right? Because this merger is seen by the market as not additive, as dilutive. Okay, it can happen, and it happens also. Now, what is the value of acquisition is the question from my side to all of you. What is the value of acquisition? Can you help with the answer? I want all of you to please think and then answer. So A Limited's market cap before merger is 2000 crore, B Limited is 500 crore, but upon merger of B Limited into A Limited, the market cap drops to 1900 crore because of some of the reasons that shareholders are saying that the acquisition will result into possible losses or the future prospects of the company is not good. So Kaushiki has mentioned minus 100 crore. Thank you, Kaushiki. Yes. So the value of acquisition will become negative 100 crore. Correct, students? So whatever is the incremental or the detrimental amount, that will be regarded as the value of acquisition, but it is always from the perspective of A Limited. Yes, Janvi, you're right. 1900 minus 2000. Namrita, you're right. 100 crore. Thank you. Okay, let's move on. Let's come to the gains / losses to the shareholders. Now, the gains / losses will be computed basis the market price. Till now, we have studied what is the impact on the earnings per share. Now we will see what is the impact on the market price. That will help us in determining the gains / losses to the shareholders. So the first one, we are trying to calculate the gain or loss to the shareholder of A Limited. So the market price per share post merger of A Limited, simply we will take and reduce the market price of pre-merger, because one share of A Limited post merger is comparable to the one share of A Limited pre-merger, and hence the gain loss will come easily. But in case of B Limited, we will again have to adjust it for the swap ratio. The same concept that we have studied in the EPS. Okay. Now see the term market capitalization. MPS into number of equity shares issued. Now, promoters holding. Almost all the companies, all the listed companies have promoter groups. Promoters are the one who actually brings the companies into existence initially. They will promote. They are the initial shareholders by whatever name you can call. So in all the companies, promoters have their shareholding. Let's say that is X%, or in this case, I have assumed 60%. Then what is the meaning of free float market capitalization? Free float market capitalization means that part of market cap which is not a promoter's holding. So market cap multiplied by 1 minus promoter's shareholding. In this case, 40% will be the free float market capitalization. Free float means which is freely available for sale or purchase in the market, because promoters holding, they will not be selling in the market. They will keeping it with them. They will be selling it only if they want to sell. It is not freely tradable in the market. Correct. Then again, two more important topics. One is the true cost of merger. Now, from cost side, if B Limited shareholders gains, that will become the cost of the merger. Correct. So the gain to the shareholders of B Limited, which is the target company, we call it as true cost of merger. And if there is a gain to the shareholders of A Limited, then it is called as the value of merger. Okay. So I think this is something we were discussing. This, I said that book value per share, adjusted EPS, all these are reflective of fundamentals, or these comes from the financials. But market has its own demand and supply game, which is also called as technical analysis. Correct? So technically these are the things, and fundamentally these are the things, and hence the share price will be reflective of both the elements. Now students, we will not be covering questions in detail, because for questions, the detailed discussions we have already done in our respective sessions. If there is anything that you want me to clarify or discuss, I would be happy to take it up. Okay, students? Now let me move on to other concepts. So through this, we would be trying to understand what is the combined market capitalization. So yes limited and no limited. Yes limited is still here and no limited is still here, and both of them are additive to the post merger yes limited's value. The questions are very easy. Janvi, the assignment is same that we have discussed the earlier ones in the detailed sessions. The assignments are same. So there is no fresh assignment for today's session. Okay, Janvi? The questions are very much same to what we have already covered. Okay, so this we would be discussing about the demerger, Fortune India Pharma, that question. Janvi, are you referring to the assignment of the previous session or this session? Please clarify, Janvi. If you're referring for this session, there is no separate assignment. Okay. Now let's come to the interesting part. And just drilling it down. See, this is the question on gross NPA. Okay, this was the question on gross NPA where we also discussed we will not do 40 by 5. We will do 5 by 40. Okay. This was clearly explained and discussed in the session. Yes. Now comes the rationale for doing a merger and acquisition. Okay, Janvi saying previous one. Okay, Janvi, let me check on this, and if it is not uploaded for the previous sessions, we will get it done. Okay. Now for synergy students. So if I say synergy is the collective operating efficiency that comes when two or more companies come together. For example, now let's say there are two companies, A Limited and B Limited. A Limited and B Limited, both of them are into the business of manufacturing and selling some of the products. Okay. Now, A Limited and B Limited both will have some general overheads, administrative overheads, which would be very much common. And combination of these two companies essentially would not mean that the fixed overheads will also continue. The fixed overheads will be reduced. Hence, the collective value of A and B will always be greater than the individual values of B and A. This is what the synergy is. And as I told you, a very practical example is the reduction of overheads. Correct? Overheads will get reduced. In case overheads are getting reduced, it will make sure that for the same level of operations, you are incurring lesser cost. Now, another example I will give you. So this A Limited is a very big company and it has a very good negotiation skill or negotiation power because it is purchasing huge amount of products. So let's say A Limited is purchasing any raw material, okay, and it is getting a discount of 10% on that raw material. Now B Limited also needs the same raw material, but it gets only 5% because the volumes are very low. Volumes of purchase is low for B Limited. So what will happen once B Limited will merge into A, then on whatever business size B Limited is purchasing that raw material, on that also the increased discount will be applied. And hence, there will be a 5% additional savings in purchase cost. Correct, students? So this will lead to the synergies. And this is the basic rationale why someone would want to acquire the other company. So Namrata, yes. Power of unity, yes. Okay, students. This is synergy. Now, the second reason or the second rationale for going into the mergers and acquisition is the diversification. So students, again, from your portfolio knowledge, we know that the unsystematic risk can be diversified. There were two types of risks, systematic and unsystematic. Systematic is one which is present in the market and which cannot be diversified. Unsystematic is the one which can be diversified through a correct combination, through the different techniques that we studied, right? So let's say A Limited is into FMCG and B Limited is into real estate. They want to reduce the unsystematic risk, and hence, for diversification purposes, they both of them combines. So that if one business fails, the other business flourishes. Basis whatever link they have, or basis whatever objectives that they have. Okay, so diversification is a very much required rationale, because some of the companies think that they would only be able to grow if they diversify, or they would only be able to reduce their risk if they diversify. Then comes taxation. Now, in almost all the situations, students, what we are seeing is that the strong company is actually acquiring a weak company. Now, what is a weak company? A weak company is some form of the company which is not able to generate returns, and hence they are into losses. And if they are into losses, that means for tax purposes also, they are having losses in picture. They also have tax losses. Essentially, it means that they are, let's say, if they are having 100 crore losses, on that, I'm just assuming a tax rate of 30%. That means 30%. 30 crore unadjusted income is lying with them. But in future, is it possible for them to generate returns? No. Because weak company is structured in such a manner that they are not able to generate returns. So what strong company will do? Strong company will say, okay, you are not able to utilize it. What I will do is I will merge you into me. And hence your carry forward of losses, I will be able to take a set off. Yes, Namrata, we can set off losses. Then once it gets set off against the future profits, we will be able to get a benefit out of it. And hence taxation also becomes one form of, or let's say the one reason of M&A. Then comes growth. The students, why will somebody take a company, or let's say merge a company only for growth purposes? The reason is a lot of financial metrics, lot of financial KPIs are actually dependent on the growth, because what most of the investors in the share market are interested in is what is the growth potential, what is the growth versus last year that the companies are delivering. In this case, we took an example of A Limited and B Limited. Both of them are operating into FMCG segment, which is the fast moving consumer goods. A Limited's regular growth is coming at 10%, 1000 crore of revenue going up to 1100 crore. However, B Limited is having a revenue of 600 crore. So this growth of the same base year on year is called as organic growth. Organic growth means which is actually coming from the same line of business. Now, inorganic growth, students, inorganic growth is something which is coming over and above the regular business. So what if A Limited is actually acquiring B Limited and B Limited is getting merged into A Limited, the A Limited's reported sales for year 2 will become 1700, correct? 1100 regular and 600 B Limited. So now you see the overall growth comes as 70%. 60% is inorganic, 10% is organic. Okay. So this will mean higher growth. Okay, students. This will mean higher growth. However, we are not saying that we will directly represent that the company is growing at 70%. No, in our financials, in our annual report, proper disclosures would be made that 60% is coming from this acquisition and hence it is inorganic growth. Only 10% is an organic growth. Okay, students? Now let's come to the fifth rationale for mergers and acquisitions, which is the consolidation of production capacities and increasing market power. Sorry, I think this is a very easier one because if there are two different companies having two different production capacities, we will consolidate them. It will lead to the consolidation of production capacities. And market power means that if A Limited and B Limited were having 60 and 10% market shares respectively, this was the example that we discussed. With that, their collective market power becomes 70%, or let's say the market share becomes 70%. That means they will emerge stronger in the market portfolio. Then students comes the different types or forms of merger. The above that we have discussed initially is the different cases on which the practical questions are based. So these are the different types and forms of the mergers. The first form is horizontal merger. So horizontal, what it means that industry, first of all, we need to understand industry. Industry is the common set of consumers with a common need. Okay. So industry, whatever output that industry is producing, it will serve the common needs of consumers. And industry is a collection of companies. It's not one company. It's a collection of companies, or let's say businesses. That is called as industry. Okay, students. Now, if A Limited and B Limited both work in the same industry and both of them gets merged, that is called as a horizontal merger because the merger is happening at the same level. Vertical merger. So students, vertical merger is one where A Limited is supplying some products to its customer and it is purchasing some products from its supplier. And if supplier is getting merged into A Limited, that is called as vertical merger. Okay, that is called as vertical merger. Wherever they have a buyer seller relationship and they are getting merged, that way it will be called as a vertical merger. Sometimes they also called as forward integration, backward integration, like that. Okay. So Janvi is saying swap ratio which the acquirer company will prefer, both on the basis of MPS and EPS. So Janvi, okay, let me put it here. So let's say B Limited is the target company and A Limited is the acquirer company. Okay, it is acquiring B Limited and A Limited is actually issuing purchase consideration. Okay. Now MPS, which is the market price per share, and EPS, which is the earnings per share. Okay. Now, what do you think? If MPS of A Limited is higher, then number of shares that A Limited is willing to issue will be lower. Correct? Because I have a higher MPS. For example, I am A Limited. I have a higher MPS. I will issue you lesser amount of shares because already my one value of share is higher than what your value of share is. And hence the formula becomes MPS of B limited divided by MPS of A limited. And in case we are talking about EPS also, in case of EPS also, if I have a higher EPS, I will be willing to give you lesser shares. Okay, students. Okay, Janvi. And this is the ratio at which acquirer will prefer it. Because acquirer will say that maximum is above. Above means these values that I have put. Target will have a different perspective, but acquirer will say that maximum I can pay you up to this much. Target will say that minimum expected as above. Okay. So both of them will have their own versions, but the acquirer company's perspective, this amount can come. Okay. Because acquirer is paying. So it will say that maximum I will be able to pay you this much. Target will say that minimum I will expect this much. Now somewhere the deal will happen. Yes. So we discussed about horizontal merger, vertical merger. Vertical merger, we said that it is also called as forward integration or backward integration. If the supplier is getting merged into A Limited, this is called as backward integration. If customer is getting merged, this is called as forward integration. This is done. This is done to make sure that the supply chain, the entire chain of the parties are reduced. Janvi saying, sir, then what will the ratio acquiry prefer? Yes, Janvi, that's what I said, that acquiry or the target company will also prefer the same ratio, but as minimum value. They will say that by minimum, we need this much. Now, beyond this, what you are giving us because of X and Y reason that you tell us. Okay. So I'm just giving a perspective from the target company also. Now comes the conglomerate merger. Now, what is the meaning of conglomerate merger? Conglomerate merger is merger between two companies which are totally unrelated. The businesses are not related at all. It's not a horizontal merger. It's not a vertical merger. It's a diversification merger. So basically the same that we discussed. Diversification is the key underlying for conglomerate merger. Okay, students. And then comes the co-generic merger. Now, what do we mean by co-generic merger? Now, please understand this as this is very, very important. Now, co-generic merger, students, it says that both the companies, A Limited and B Limited, are either in same industry or they have some factors in common. What are those some factors? For example, they have technology in common, technique. I would say technology in common. Or they have distribution channel through which their products are being sold is also common. That means they belong to the same genre. I think you would have heard this term, same genre, or let's say they're two different businesses, but they have same basic genre. Correct? Let's say the genesis is same. Then that merger is called as co-generic merger. Now we will try to understand it through one of the example. We said that both the companies are, let's say, NBFCs. This NBFC is the NBFC in the auto loan segment. They are giving loans for the purposes of buying a automobile. This NBFC is actually giving the credit cards, which is one form of personal financing. Now, do they have different consumers? Yes. Auto loan will have different consumers, credit cards will have different consumers. But are they into the same industry? Yes. Giving loans to, which is the NBFC. So giving loans to someone is form of the same industry. Second question, channel through which they access the customer is also common, because they will be using the help of some, let's say, agents. Correct. Then third, their product lines. They have, what is the basic feature of their product lines? This is a loan which will involve interest, that will also involve repayment, and then there will be some kind of a security or not a security depending on the product type. So the purpose of loan is only different, but the product line is very much common. Hence, if these two companies gets merged, this is called as a co-generic merger, because they belong to the same genre of the business. Okay, so there is some commonality, and hence this is called as a co-generic merger. Then this reverse merger I'm skipping as of now, students. We will cover it in just 5-10 minutes from now. Acquisition. So we said that how acquisition happens by purchasing a majority stake, or if we do a share, if we do a agreement also, that gives us the power of control, power to control, then also acquisition will happen. Okay, students, these were some simple things. Then we said that there is a scheme that has to be filed, for which there is an effective date, and there is a valuation of shares is also included in that scheme, and that scheme has to be approved by the creditors, by the people who have given the amount or the borrowings to the company, even the shareholders, and even by the courts for that matter. Okay. Now let's come to the topic of reverse merger. Now, students, please pay attention for next 5 to 6 minutes. And later on as well. But for reverse merger, we will be covering it, or we will be revising it in next 5 to 6 minutes. Reverse merger. So students, large companies generally take over the smaller companies, that we all know, correct? However, reverse merger will mean that the small company will take over large company. How? We have taken an example here, smaller companies, private limited company, and large company is the public limited company. Okay. Now, public limited company will get merged into the private limited company. That is the scheme of amalgamation. We also need to note that this public limited company has accumulated losses, and there is no operating business that is as of now going on. There are shareholders of A Limited and B Limited both. What they will do is, A Limited shareholders will get the majority stake in the public limited company. So the A Limited shareholders will get shares of B Limited, and B Limited shareholders will get the shares of A Limited. Okay, so they will swap their shares. The moment they do that, and the public limited gets merged into A Limited, now the shareholders of A Limited are having the shares which are listed on a stock exchange, because they will hold now the collective shares of A Limited and B Limited, which is the merged entity. Okay, students, I hope this is clear. With this, the private limited company has already gone public because the shareholders of private limited company are now holding the shares of such entity which is listed, and hence after the merger of both the companies, one company remains and hence it has gone public. So here we say, let's say the private limited is the transferee and public limited is the transferor. Okay, so there are three, four conditions. So the first condition is that the net assets of the transferor should be higher than the net assets of the transferee company. Second condition, there will still be left a minority. After the merger, the public limited's minority shall remain same. The third condition is the equity shares issued by the private limited company before should be lesser, and after whatever in higher equity shares that private limited companies is issuing, that should be higher than the previously issued shares. Let's say 5 lakhs were the previously issued shares, 10 lakhs more are required to be issued, hence 15 lakh. So since 10 lakh is higher than 5 lakh, it will qualify for a reverse merger. Okay, students. So actually see, the reverse acquisition is a very big topic. We have some limited understanding, or let's say the limited coverage, and hence we have covered in that form only. Okay. Then comes divestiture. So students, divestiture was something that involves selling of the assets, or let's say class of assets or business units. Okay. That is called as divestiture. Divestiture means selling anything, single asset, class of asset or business unit, so that they can pay attention to their core business. They will remove the redundant part. Now, what are the different forms? One is sell off or partial sell off. In this, we will just sell. That's all. We will just do a scrap sale, or let's say slump sale. Second is spin off. Spin off, what we will do is we will sell to another company which is formed by us only. And in the new company, the shares will be issued to the existing shareholders. So spin off means that one business is spinned off and they will issue shares to the existing shareholders. We are not selling it. We are actually taking it separately to a separate company. Split up. Split up means that A have different businesses and all these businesses now will become different company, B, C, D, E, and A will get dissolved. This is called as split up. So it is getting split up. Equity carve out. Equity carve out is spin off plus issue of new equity shares also in the market. So there is a new company formed. That new company is issuing shares to the existing shareholders, and it is also issuing new equity shares. That is called as equity carve out. Yes. So students, now let's break for 15 minutes. So it's 8:14 now. We will again reconvene at 8:29. Okay. And post that we will cover our other topics. Okay, Namrata, I will cover the spin-off again. Okay, after the break. So welcome back, students. There was one question from Namrita on spin-off. Let me explain spin-off again. What we said that A Limited is, let's say, having two businesses, business one and business two. So what A Limited is planning to do is transfer this business two to a newly formed company B Limited, and B Limited will issue equity shares to the shareholders of A Limited. This is called as spin-off. This entire process is called as spin-off. And ultimately now A Limited will have B1 business, B Limited will have B2 business. Simple. And both of them will be held by the shareholders of A Limited, the previous A Limited. So earlier also the shareholders were holding both the businesses through A Limited. Now also shareholders of A Limited are holding both the businesses through A Limited and B Limited respectively. Okay. Okay, Namrita. So this was the divestiture part. So divestiture meant the exact selling of the assets, class of assets, business units by forming a new company through a demerger or through an equity carve out as well that we have discussed. Now we also said that demerger or division of the family managed business is also one form of M&A, right? In demerger, typically spin-off would be the right case to link with the demerger. In demerger, one company becomes two companies, or let's say one company sells part of its business to the other company. Then comes financial restructuring. So students, financial restructuring is one form of restructuring to make sure that whatever is the sick company. Now, what is called as sick company? Sick company is something which is having a good amount of accumulated losses, which is not able to generate cash flows, which is not able to generate business profits, or let's say EBITDA. That is called as a sick company, where the accumulated losses are greater than the share capital. Correct. And they have negative net worth. So the financial restructuring is required for such kind of companies. How it will be done? The financial restructuring, it is done through the use of simple techniques. So first of all, there is a professional who would be deployed for the financial restructuring. They are called as, let's say, the experts. And what they will do is they will first of all study what are the recoverables or what are the assets and what are the liabilities of the businesses. Now, wherever there is a liability outstanding, they will restructure it. How they will be restructuring it? They will say that instead of today, we will pay you 3 months later on. And instead of 100% amount, we will pay you only 95% because our company is going into the restructuring plan. Similarly, borrowers, as a borrower, so the banks who have lended to us, we will tell them that initially your rate of interest was, let's say, 10% agreed, but because of this financial restructuring plan, we will only be able to pay you 9.5%. That is also one form of restructuring. Correct. So that is the entire plan is called as financial restructuring. Okay, students. And that is to revive the sick company. Yeah, so I think these were the pointers that we would be discussing in our session. Let's say equity shareholders, we will say it is 10 paid up. Now it will become 5 paid up. Loan earlier, it was 10%. Now it will become 9%. Vendors, we will say that 25% the amount is lost. We will not be able to pay you back. Okay. Then on the asset side, There are some debtors on which the bad debts has to be written off, and some loan that we have taken, we will convert it into the equity. This is on the liability side. Okay, so that the cash flow is saved. There is no need to pay the cash flow. The same has been converted into equity shareholder. Then comes a different topic called what are the ownership restructuring. So ownership restructuring is the first point, which is going private. Now what happens? There is a public limited company, and that public limited company, the shareholders, or let's say the founders, or let's say the promoters, do a buyback of own share from the market. Okay, they can do buyback subject to the regulations. Once they do the buyback from the market, they withdraw all their floating capital. Free float market cap goes zero. And now the shares are held by some of the individuals, and hence they can go private. So from public, they are going to private. Then management buyouts. So second form is also there, management buyouts. In this case, what happens? Management itself will purchase the shares of the company. That is called as management buyout. Okay. So earlier, whosoever is managing the board of directors, or let's say the other people, they will themselves will buy the company. Then there is one very important term called as leveraged buyout, because this you will be hearing a lot. So leveraged buyout means for merger, there is a purchase consideration needed, and that purchase consideration is paid in cash. And for arranging funds for this cash, they will take up borrowing. The person, or let's say the company who is discharging the purchase consideration by paying in cash, borrows that amount from outside. This is called as leveraged buyout. So the buyout that happens after borrowing amount is called as leveraged buyout. Then comes equity buyback. Equity buyback is again the same concept that we have studied in going private, wherein whatever equity is there, it would be bought back. Correct. So going private is one form of equity buyback. So equity buyback can result into going private, and it can also result into not going private. Okay, students? Are there any questions till now, students? Then we will go to the last topic under mergers and acquisitions, and then we will take up the startup finance as well as the value add risk. So a lot of companies do this leverage buyout, in which they will borrow funds, then they will go for the acquisition or mergers. That is called as leveraged buyouts. Then this is the last topic of mergers and acquisitions. This is called as special purpose acquisition companies, SPAC. Now, students, please understand this topic very carefully because this is something that is not a business as usual. Okay. Now, assuming that there is a company which wants to raise funds from the market, they will go for an IPO, initial public offer. They will raise funds from the public at large. Correct? And it involves definitely cost. So what these SPAC companies will do, they will go to the market, do the IPO, raise funds. But while raising the funds in the prospectus or in the offer documents, they have to be mentioning it very clearly that what is the end use of the money that they are going to do, or what is the use of this money. The purpose of this IPO is not very much clear on the day one itself. Okay, so what they will do, they will take the amount and keep it in trust form, or let's say in an escrow account. Okay. They will keep the money in trust form, and after raising the money, then in the next 2 to 3 years, they will try to target some of the acquisition related companies that whom they want to acquire. Then they will finalize a deal, right? The SPAC companies, they will finalize a deal that they want to acquire XYZ company. And before finalizing, they will also need to take an approval from shareholders. After this, we are talking about after 1.5 years, once they are able to get the leads on what are the deals available. And till the time deal is finalized, money is kept safely in a trust or an escrow account. And upon finalization, if let's say some of the shareholders are not agreeing to the deal, then they will also have a provision to pay it back. What SPAC company will do? SPAC will pay that money back to the shareholder because they are not agreeing with the deal, or they are not in for the deal. But whosoever are in for the deal, for them it is finalized and they can give an approval, and their money will be invested there. For this, there is a proper independent due diligence has to happen of the target companies. And we call SPAC companies as a blank check companies because we don't know in whose name we are giving the money. Correct. Tomorrow, wherever SPAC would want to invest, they will just go and invest it. Okay, students? And why SPAC companies are gaining more importance? Because it will lead to higher returns. Because in a way, today, it is not, I mean, if it is not clear that what is the purpose for which the amount is going to be utilized, that means it is a highly risky situation. And to avoid the highly risky situation, the companies compensate investors with the higher return. Okay. So students, any question till here on M&A? We would be happy to take it up. Otherwise, let's move on to the next topic. Are there any questions, students? Even from today's session or from the previous recorded sessions that you all would have gone through? Okay. Let's come to startup finance. So this topic is gaining more importance because of the ecosystem that we are into, and we are witnessing a big amount of change the way businesses are done today. Because for any startup, the technology is at its core. They will use technology to the fullest for solving any problem for which there is no ready-made solution available as of now. Correct. And they are high growth intensive companies. They are high potential companies. And definitely the investors who invest in startups do invest behind the ideas. So this entire topic of startup finance is to introduce to all of you first, what is the meaning of startup? Second, what are the different financing opportunities available for a startup? And we will also cover one structure of, let's say, a venture capital, private equity, or whatever maybe you can call of. That structure also is very important to understand. Okay. So startup finance. First part, we will understand what is the meaning of startup. This is a legal definition because the government of India came up with a notification to avoid any ambiguity. and they have notified what are the definitions of a startup, or let's say what are the preconditions required for any business to qualify as a startup. So the first condition, the first and foremost condition is up to 10 years from the date of incorporation. Any company which is only 10 years of age, up to 10 years of age, should be regarded as a startup. We cannot say that a company which is 15 years old will also form a startup. No, only the initial stages of 10 years, only the initial, let's say, age of the business of 10 years will qualify them as a startup. This is very true, correct? Because the first and foremost things that come into our mind is startup. Correct. So the start will not happen after 10 years, right? Start is initial 10 years. Then the legal form. What can be the legal form? Can it be a public limited company listed on a stock exchange? No, right? Because already if it is a public limited company listed, then it's not a startup. It already has raised amounts and multiple shareholders are part of it, and its shares are also getting traded in the market. So the legal form is a private limited company, is a registered partnership firm, and a limited liability partnership or a limited liability partnership. So private limited company is one form where the company legal entity is there, but it is private. That means it is a smaller one. Now, registered partnership firm, that partnership firm which is actually registered. We cannot say any partnership firm. The partnership firm has to be registered. Then limited liability partnership is already registered, so hence we have taken that. Now, question to all of you students, does sole proprietor would come under the startup definition? By only understanding this, can we say a sole proprietor could also be a startup? No. If any one of you can attempt this. Meanwhile, let me go to the next condition. If maybe there is some delay in the responses. So the third part is actually the turnover part. So they have given a capping on the turnover as well. What they are saying is that turnover should not exceed rupees 100 crore in any of the financial year. Because the moment you cross 100 crore, that means you are running a business at a higher scale. Correct. And business at a higher scale, we actually cannot classify it as a startup. Janvi is saying no. Yes, Janvi, sole proprietors are not included in one of the legal form for startups. Then fourth condition, it should not be because of the reconstruction of a business already in existence. Munish Gupta is saying as it will not be a registered entity. Yes, Munish, you're right. This is perfect because we are already covering the registered partnership firm. Sole proprietorship is not registered. How can it be covered under a legal form of a startup? That is perfect, Munish. Thank you for answering, Munish and Janvi. So the point we were discussing is that it should not be because of any reconstruction of already a business existing in place. For example, there are big business houses. While Government of India has introduced the startup definition, they have also introduced some of the incentives in taxes, in other areas. To avail that, now these big business houses, what they felt is they're already some of the businesses in existence, they will do a reconstruction, they will do a demerger or spin-off, will create a new company which will satisfy all the A, B, and C above, A, B, and C, all the three conditions. and they will claim all those benefits and regard them as startups. Do you think that is it the right thing? No, right? So hence it should not be because of reconstruction of a business already in existence. Because if it is some of the business already in existence, reconstruction of a business already in existence, then it's essentially not a startup. You are just creating a legal form, separating a legal form to get the benefits. So Janvi and Kaushiki, both of them are asking about the OPC. So Janvi and Kaushiki, we might need to check the exact notification language because the notification language only covers these three forms. So although OPC, one person company is registered, but whether the language covers that is or not is a question because it only covers the private limited company, which is definitely not a OPC. Okay. So Kaushiki is asking if startup company reconstruct within 10 years, will it be a startup? No. Any kind of reconstruction or reconstructed company of any business already existing will not be regarded as a startup. Now, innovation and the last and the very important part, which is the E part, is around the innovation or development of new product, process, or services, which is driven by technology at its core. If there is no technology, if let's say I am just doing a simple trading business in a conventional form and I satisfy all A, B, and C, D, and above, will I be regarded as a startup? No, right? It's just a normal business. The startup means that there is some use of technology, there is some use of intellectual property for devising a new product, for devising a new process, for devising a new services which is not into existence, or some kind of a big innovation that is driving at its core. Okay. Now, since these startups have a huge amount of technology, they need to invest a lot. They need to really invest a lot behind their research and development, behind their technology, and even behind the initial market building because there is no existing market of these products. Correct. There is no guaranteed or existing markets. They will have to invest a lot. For investing a lot, they need finances. So the biggest issue for a startup is to arrange finances or to arrange for the investors. How they will do that? The first form, or let's say the modes of finance, is bootstrapping. So bootstrapping is actually making available the existing resources without looking outside. There are two subparts to it. One is personal finance. So for the founders, essentially whosoever is floating a startup becomes a founder, right? So for a founder, he or she might have some kind of personal savings as personal finance, or not even that. They would also be having their personal credit lines. Even those can be used as bootstrapping, one of the modes of financing the startup. Then operating cycle of the business such that we are paying on credit to vendors and realizing from debtors in a timely manner. Let's say we close payment terms with vendors as 45 days and we close the receivable terms, or let's say the payment terms from debtors also, in 15 days. Essentially, we are enjoying the credit, extra credit of 30 days. That is a operating cycle of business through which we can do the finance, because for 30 days that cash is available with now, which we would have paid it earlier. So this is the trade credit in which I specified that asking for credit from vendors, we will ask for a higher credit. Now, A, let's say, is a vendor, S is a startup, and this A vendor belongs to S. 20 days is the credit period. Correct. And then I think I would be trying to explain something here, but what the essence of this trade credit is that asking for credit from the supplier. Because the more you get the credit, the better you will be able to manage your working capital. Okay. Then B is factoring. Now, the second part of the operating cycle is factoring. Now, what does factoring means? Factoring are those processes by which the receivables of a startup gets discounted and gets paid early than the agreed timelines. For example, S is a startup again, and D was a debtor from whom 1 lakh rupees was due. And that was due in 30 days. 30 days is the credit limit. However, they approached a bank and bank factored it, and after 30 days, it will recover amount from D, but it pays today only to S. Now, either it can pay 98,000 or 1 lakh. That depends on the agreement as a whole between S, D, and bank. In some of the cases, what we have observed is that if the interest cost has to be borne by S, then bank will pay 98 and recover 1 lakh from debtor. If the interest cost has to be borne by debtor, then bank will pay 100 here and recover 102 from debtor. Okay. I hope this is clear, students. Okay. So factoring is also one form of getting the money before than what is expected. But factoring actually happens in two forms. One is on a recourse basis and second one is a non-recourse basis. So the recourse basis means that base where the bank can come back to S in case of a default. Yes, Namrata, recourse and non-recourse I am explaining. In general language, the recourse means that in case of a default, I have a guarantee. I can go back and claim the amount from S. This is from the standpoint of bank. Non-recourse means that if there is a default, then I cannot go back to the startup and say that there is a default happened. You pay me back my money and you separately recover it from D. I will not be recovering it. This is a non-recourse. So recourse actually is risky. The risk is not covered. The non-recourse risk is covered, I can say. And hence the commission, or let's say the bank's related revenue will be higher. Here commission would be lower. Because bank is only covering for the time value of money in recourse. Here the bank is covering even for the time value of money and the default as well. Okay. So Namrata is saying, yes, we need to refer the recorded lectures. So this is just a revisionary session again, Namrata, for startup finance. Or maybe even if you want to, I mean, startup finance is not that big. Even in through this also, we can actually cover up the entire topic because I'm covering everything in detail only, Namrata. Okay. So even if you hear out in this session, it should be okay if you have not seen the recorded lecture earlier. Yes, Namrata, you're right. Commission is more in case of non-recourse. That is perfect. What is the benefit of bank in factoring? Is it charging any interest on the money lend? Yes, Namrata. As I told you, that bank has earned 2,000 rupees in the entire arrangement, either from S or from D. That is a secondary question. Only bank can do factoring. Bank can do as well as other financial institutions can also do the factoring. Okay. So we have done the trade credit, factoring. Now let's come to leasing. So what is leasing and what are the benefits of leasing? Leasing is actually taking something on rent, which is furniture, fixtures, PP, and computer. If we have not taken it on rent, we would have paid, let's say, huge amount of capital to invest it. So rather than taking capital on borrowing and then investing on all these furniture, fixtures, PPE, and computers, it can just be simply taken on rent. The initial laptops can be taken on rent and the work can carry on. So it is also one form of financing. Sumit is asking, by default, it is non-recourse. Yes, Sumit. It can again, it would be better to specify whether it is non-recourse or recourse in the entire arrangement of factoring. Okay? Because the default plays a very big role in determining the commission of bank. Okay? Whether the default is covered or not covered, that plays a very big role. So it is better to define it early. Now, after bootstrapping, the second bucket of mode of financing is the angel investors. Now, who are angel investors? Angel investors are actually known contacts of a startup. For example, Mr. A is a high net worth individual and he is actually a known contact to Mr. B. Mr. B has recently floated a startup. And Mr. B is in need of money. So one form is Mr. B can actually take use of bootstrapping that we have discussed, whereas let's say personal financing, operating cycle in the form of trade credit, factoring or leasing. Or it can also approach Mr. A because he's a known contact and tell them that whatever your savings are, or let's say out of that, if you can invest this much to the startup or to the idea that we are proposing. So in this case, Mr. A will be called as angel investor. And angel investor will also say one more thing, that I'm not as of now expecting any return. If you're having that, you can give me. If you're not having that, we will see how to settle it later. So there is no clear-cut expectation on the return side from the angel investor. Okay, students? Then comes a very, very important part on venture capital. So this is the third mode. Now, students, please pay your all the attention because venture capital is somewhat very much important. And this existed even before the startup era. Now, what is venture capital, students? Venture capital is actually one form of private equity. I think this terms you would be hearing a lot. Venture capital, private equity. So these terms you would be hearing a lot in your practical life, or let's say in your sources around. So first of all, students, for understanding private equity, we need to understand what is called as public equity, because opposite of public equity will become private equity. What is public equity? Public equity is actually done through an IPO. Correct? There is an initial public offer. For initial public offer, there is a prospectus. There are multiple investors. Generally, this is public at large. Correct, student? These are public at large. They will invest. After investing, there is a book building process that happens. Correct? And then the listing will happen. This is the process of an IPO. Correct? And hence, this is called as public listing, or let's say the public equity, because it is issued to public at large. What is private equity then? Now, students, please apply the mind and tell me, if this is public equity, public at large, what is private equity? What do you think private equity would be? Okay, students, please respond. Sorry. Okay, meanwhile, Namrita is asking what is book building. Students, what happens if I have floated 1 lakh shares at minimum price of 100, minimum bidding price of 100? I receive an application of 1,20,000 shares, but the bidding, and I open it for bidding, right? What is a book building process? Because in IPO, generally, I float number of shares and I will decide the floor price. On that floor price, the investors will do the bidding. Correct. They bid, let's say 120, 110, 100 also. Then the allocation of these shares and arriving at the final issue price is the process called as book building process. This is very interesting. If you have further interest, please do read about this. But I'm just telling you in brief, it happens through a book building process. Okay. Now, Munish is saying allotment to close investors. Yes. Kaushiki is saying offer to some selected people only. Namrita is saying issue of shares to limited group of person. Perfect. Janvi issuing equity share to a known person or some people only. Yes. Sumit is saying personal capital of a person is a private equity. He's asking, okay. No, Sumit, here we're talking about from the investment standpoint. Okay. Personal capital is a personal wealth, correct? That is kept nowhere. So that if it is invested privately, it is called as a private equity. So I think all of you are right, students. Thank you, Namrita, Kaushiki, Munish, Janvi, Sumit, everyone. I think all of you have given right answers. Private equity is something which is offered privately through private placements. And this is not true for a public limited company. Correct. Because if it is a public limited company, always it can be a public equity. And venture capital is actually one form of private equity. Okay. Namrata, you can actually search it from the internet. There are a lot of sources available. Although, if you see, there is a SEBI regulations. There is a proper SEBI regulations. ICDR, if I'm not wrong, issue of capital and disclosure requirements. ICDR. But this is a very big regulations. But if you want to understand really, you can search through internet. ICDR actually defines the entire process of how what should be the contents in prospectus, how should the book building process happens, how much of the total issue size should be reserved for public, should be reserved for promoter, like that. All those things are there. Okay. But for SFM, that is not part of it, and hence we are not covering it. Okay, I am coming to all of your questions. I'm happy that all of you are asking questions and getting involved. Now, Sumit is asking, before going public, the funds are raised from private placement. That is true. Because before going public, all the companies are actually doing businesses, right? And for doing businesses, they already are having funds which are invested privately. Sorry. Now, Munish is asking, what is the difference between angel investor and private equity? I will actually cover private equity in detail. Then we will cover the difference. Okay. Because angel investor has just invested and he's just sitting as a sleeping partner without any expectation of return. And he's a very known contact. Private equity, on the other hand, there is a proper structure. We will discuss that structure now. Okay. What is the difference between private? Namrita is asking, what is the difference between private limited company and venture capital? We will cover that. Now I am coming to the exact structure of venture capital / private equity. Okay. Now, pension funds, banks, high net worth individuals, and corporations are always having surplus cash. They always have surplus amount which can be invested. What they do, they create a pool of money in the form of a funds. I'm sorry. Yeah. So they create a pool of money in the form of funds. And from this pool of money, they will invest equity in the startups. Sorry, we are talking about venture capital here, okay? So they will invest equity in the startups and this will be invested from this pool. Now, what are the objectives of these investments? There are three objectives: buy, grow, and sell. First of all, for buying, identify the deal. What is the right company to invest in? Then evaluate the deal. What returns can be expected? What is the future outlook of that company? How that company is going to perform? And then execute the deal. In execution, the actual investment will happen. Okay. Then the second objective is the growth. In growth, decision making happens. So the private equity, or let's say the venture capital firm, will also be involved in the day-to-day decision making through board of directors. They will have a seat in board of directors. Sorry. And they will make the deal successful. They will see if the overall direction in which the company is going is right or wrong, and hence they will help in the growth. Then ultimately they will sell. After they have made the business on a reasonable size, let's say they will they will decide to sell it after 5 to 10 years of the investment. This is the time horizon. Today, 5 to 10 years, after 5 to 10 years. Now, these are the life cycles of a venture capital fund. First of all, they will do the fundraising. Then there is an investment phase. Then there is a holding period. And finally, they will exit the investment. And what are the things that VC will look for? Now, the startup will be a high growth technology, right? They will also want to create that brand awareness, and hence they have to invest behind media, which is the advertisement. And they also want to see the companies are actually consumer driven companies. They're actually solving for consumer issues on ground. Correct, students? So this is the overall framework under which the VC would operate. Okay. What they will look for? They will look for high growth technology. Wherever the technology has a high growth potential, there has to be a proper advertisement behind the brand building. And there has to be a proper solution for some actual consumer issues. Correct. Now comes the structure. This is the structure. So first of all, there is a private equity firm. There is a firm which has a business, or let's say which has a objectives of having a private equity. They will float a SPV, special purpose vehicle, in the form of a trust or in the form of LLP. And they will ask these pension funds, banks, financial institutions, HNI and corporations to invest in this SPVs in the form of trust or LLP. They are called as limited partners because their liability is limited to the extent of the capital that they have not yet contributed, but they have committed. For example, shareholders are always have a limited liability, and their liability is limited to the unpaid part of the share capital, correct? Similarly, limited partners also have their limited liabilities because they are acting as a shareholders for this SPV or trust. The private equity will be a general partner. They will also nominate some of its partners and they will regard it as a general partner for this SPVs. These are called as general partners. Okay. Now, apart from that, there is a manager or advisor also appointed whose responsibility is to evaluate the deal or to advise to the SPV whether to invest or not to invest. Okay. And then essentially what will happen? The SPV will invest in investment 1, 2, and 3. They will evaluate which one to buy, which one to hold, correct? And whether to buy also or not, whether to enter also or not, they will evaluate the entire deal. Okay, student. So I think Sumit is asking, they come for offer for sale to sell its shares to public in IPO. Now, Sumit, they will do it once they decide, when the startup decides to go public. For example, Paytm. Paytm have decided some years back to go public and they have floated an IPO. Then they will become a public limited company. They will remove from the startup label and become a normal company. Correct. But the venture capital here is would happen only in a private, closely held company. Because venture capitalist or private equity, apart from the resources that they're giving, they will also partner with the investments that they have done behind their expertise. So they are also experts, correct? So they will, while sitting in the board of directors, they will guide the entire company how day-to-day decision making should happen, or how they will also leverage their expertise in the business. Okay. Okay, students. Now, I think Kaushik is saying, please consolidate these six steps again. Okay, let me consolidate. So there is a private equity firm which will float a SPV. SPV will accept the funds from limited partners. They are the investors in the SPVs. Some amount of contribution would also come from the general partners, which is appointed by the private equity firm. Private equity and general partners are same. Okay, they will also give, let's say, 2% contribution. Okay, 98% will come for the fund from these and 2%, so that their ownership is also at stake. And they will appoint a manager or advisor whose job is to deal with the whose job is to bring the deal, evaluate the deal, put it in front, advise, manage all those things. Then finally, trust will decide to do the investment in different companies, in different startups. Correct. And these general partners hold a fiduciary relationship with the limited partners. They hold a fiduciary relationship. They have to act always in good capacity, in good faith to the limited partners, because limited partners have no representation in SPVs, right? They have just given the money. Now that money rests with the private equity firm's general partners. They will invest basis the advisory received from the manager or advisor. Okay, Kaushiki. Now let's move ahead. If all the above parties are in India, they are called as domestic structure. Offshore structure. If let's say startup is in India in which the investment is happening, that startup is located in India, the SPV trust or LLP is incorporated outside India. The SPV, which is created by the private equity firm, is incorporated outside India, and the advisor or manager is also in India, who manages or gives a due diligence on the project or deal. Then it is called as offshore structure. This is called as offshore structure. Okay. Because the SPV or trust is located outside India. However, the manager is in India and the startup is also in India. Let's come to unified structure. In unified structure, SPV is outside India. The special purpose vehicle is outside India. But the trust created by that SPV is in India because the Indian investors has invested in that trust. Sorry, that is called as unified structure. And again, the startup has to be in India in which they are investing. That has to be in India. That is called as unified structure. Namrata is asking limited partners means. So limited partners means that their liability is limited. So Namrata, you see that as an equity shareholder of a company, liability is limited, correct? Because it's called as a public limited company, private limited company. The name itself is a limited. Limited means their liability is limited. It's not like a partnership firm. It's not like a sole proprietor where liability is unlimited. So similar way, these limited partners have a limited liability for the contribution that they're supposed to make. That means the commitment that they have given, only to that extent their liability is limited. Okay, students. Okay, Janvi is asking offshore again. Okay, Janvi, offshore. Offshore is where, first of all, the startup has to be in India. Okay, in which the investment is happening, that startup has to be in India. The SPV, the SPV which has that trust or LLP is incorporated outside India, and the advisor manager is also in India. That is called as offshore structure because the SPV is outside India. That's right. Now comes the next part. I hope now your other queries earlier are very much clear. The difference between venture capital and angel investor. Because angel investor, as I said, that will do nothing. It will just invest and it will wait for the return. But private equity or venture capitalist will invest They will also take part in the day-to-day decision making. They will also form part of the board of directors. They will make the company grow, and then they will sell it. Okay, so they are very much integral part of the financing. Now there are different innovative ways to finance a startup. What are the innovative ways? One, personal financing, that is invest your personal savings. Second, use personal credit lines, that we have already discussed. Sorry, I have to wait here because Namrata is saying repeat the unified structure. Okay, Namrata. So, let me go to the unified structure. In unified structure, the trust is in India, in which the amount is being held, it is in India, and even the Indian investors are also investing in that trust. But the SPV who is floated by the private equity firm is outside India. The special purpose vehicle is outside India, and they're investing in the startups in India. This is called as unified structure. Yes, Namrita, angel investors are not involved in the day-to-day decision making. Okay. Coming back to the innovative ways, it can also come from family and friends, like angel investors. Then peer-to-peer lending. Let's say there are two founders. They are into peer-to-peer lending. For example, one founder of different startup. There are two founders of two different startups. This founder says to the other founder that I will give you money because today I have excess. Now, after 1 year, if I need money, you give me that money back. Okay. That is called as that is called as peer-to-peer lending. Crowdfunding. Crowdfunding is also one kind of a startup, in which what happens, there is a platform or there is a website. Okay. On that platform, there are different startups that are registered. They need money. Correct? Their business cases are registered. What are they doing? What is their business size? What are their ideas and all those things? And the individual small investors are also listed. They are also registered on the website. So they will go through the profiles of these startups and invest small amounts also. Let's say as small as 100 rupees. They will invest. Okay, this is called as crowdfunding because the individual small investors represents crowd. Correct? And through this platform, they will select their own startup in which they want to invest, and they will start investing behind it. Okay. Janvi is asking difference between unified and offshore. The difference is that the trust in case of unified is in India, and an Indian investor can also invest in that trust. Okay. But in an offshore, the trust is outside India. Okay. Then comes vendor financing. Vendor financing is, microloans. Microloans, as the name suggests, is the loans in smaller amounts. Vendor financing, credit from vendors. We have already discussed, right? Wherein we will ask vendors to give us more credit, period. Purchase order financing. For purchase order, we can seek an advance. Let's say we have got a purchase order. For that, we can seek an advance before we can start our factory, before we can start our activities. Then factoring account receivable, we have already discussed, students. Okay. Any question in startup financing, because most of the topics are interrelated, but we have to keep in mind while the question comes in examination, what are they exactly asking? Are they asking about the innovative ways of financing a startup? All these topics are covered from the study material itself. I have kept the same topics from the study material itself, right? So if the question comes on innovative ways of financing, we have to write this. If the question comes on, let's say, offshore structure, unified structure, we can actually refer the exact text that is given. So this structure is to make you understand how a venture capital or a private equity firm functions. Then We have also covered the modes of financing, in which we covered bootstrapping. Under bootstrapping, we covered trade credit, factoring, leasing, and then we covered angel investor, and then we went on to the venture capital. Correct? So Sumit is asking, is there any platform purchase order financing? Sumit, I am not aware about it, if there are any, but according to my knowledge, it actually depends on the company to companies also. For example, the two companies have a policy. As a company, if I don't have a policy to give any advance, there is no advance. If as a company, I have a policy to give advance, the way I'm doing a PO, let's say 50% advance on PO, I can give that as an advance. So that the startup company who's receiving the PO can start their own work. Okay. Namrita, we can raise these loans from the financial institutions, the banks, anywhere we can raise it. Okay. Then comes value at risk. So value at risk, students. I think now this is a very separate topic from the startup financing. We have covered the startup financing. Okay. Now comes value at risk. Yes. No, Munish, bank don't provide an advance against a PO. Okay, Namrita, thank you. Banks, I have not seen banks advancing anything against PO. They might see what essentially happens. There is a term called documents against acceptance, DA, in the international trade terms. Okay. In that case, what happens is the banks might advance money basis a pro forma invoice. If let's say you have a pro forma invoice and you have to start work basis that pro forma invoice, you can present that pro forma invoice to the banks and banks might give you some money. Okay. So PO along with pro forma invoice is what I can say. Then comes value at risk. Now, value at risk, students, we have to understand it. So this entire topic is actually revolving around the normal distribution table. First of all, let us try to understand what does this definition says. Value at risk measures the maximum potential loss in the value of a portfolio over a given period of time for a certain confidence level. I will explain each and everything in detail. Okay. Yes, Manish, packing credit financing and export, that is available. Yes, you're right. That can be given. Okay. So value at risk measures the maximum potential loss in the value of a portfolio over a given period of time. So first of all, let us understand what is this confidence level. So we have mentioned it at a certain confidence level. What do we mean by this? Confidence level is actually a probability. Sorry. Let's say I say that the confidence level is 95%. That means the probability I'm talking about is 95%. So what is the maximum potential loss at a 95% level of confidence? Matlab at a 95% probability, what is the maximum potential loss? Sorry. Now, this value at risk is actually a mathematical model. Okay. That mathematical model has some inputs and have some output. What are the inputs? So the inputs are one level of confidence, which is the probability itself. standard deviation of returns of a portfolio. Now, students, we are actually restricting our discussion of value at risk from a portfolio standpoint. Okay. From a portfolio standpoint, we are actually restricting the discussions. Hence, we have to see what are the standard deviation of the returns of that portfolio historically that has happened. Kaushiki, I will come to that. Probability of what? I will come to that. Okay. I'm just trying to register these words in your mind that confidence level is probability as of now. Okay. So level of confidence is one input. Standard deviation of returns of a portfolio is second input. Then value of the portfolio is also another input, because we need to know that how much value you have invested in the portfolio before we can tell you that what is the maximum loss. And then what time horizon are you looking at? Namrata, I will come to that probability. I will explain everything. Just allow me 10-15 minutes, then we will be able to link the entire concept. Okay. So time horizon or time period is also necessary, because higher the time period, higher uncertainty and higher potential loss, higher degree of potential loss, correct? And the output is in the form of maximum potential loss. This is the output. Okay, so as a plain understanding, as of now, we know that value at risk is a mathematical model that will give us the maximum potential loss for a given set of inputs. What are those given set of inputs? Probability, standard deviation, value of a portfolio, and time. Okay. Yes. Now let us try to understand through these two statements that I've mentioned here. So the probability to reach Mumbai from Delhi within 2 hours is 95%. Okay. The probability to reach Mumbai from Delhi within 2 hours is 95%. So the level of confidence is 95%, which is the probability, correct? Now, level of significance. If I tweak the same language like this, probability to reach Mumbai from Delhi beyond 2 hours is only 5%. If 95% of the times I will reach from Mumbai to Delhi within 2 hours, that means only 5% cases I will reach more than 2 hours. Correct? So the negative statement, if I write, that is called as level of significance. So 100 minus level of confidence becomes level of significance. We will come to that number. Why we use this, what we use this. First of all, let us try to understand what is this. Okay. Are these two terms clear? Level of confidence, level of significance. Level of confidence is the absolute, is the probability for that event to happen. And level of significance is the probability of that event not happening. If within 2 hours I'm able to reach 95% of the time, that means more than 2 hours I will be reaching for the 5% cases. This is called a level of significance. Now let us come here. Confidence level 95%, significance level 5%. Okay, if confidence is 95, significance is 5. If confidence is 50, significance is also 50. Time period is for 1 day. We're trying to analyze our portfolio for 1 day. Portfolio value that we have invested is 20 lakhs. And if you tell us the standard deviation, we can tell you that maximum loss will be how much? See, now this statement explains. within 1 day, the maximum loss is 20,000. The probability of this is 95%. So students, see, this is why this is confusing, because in most of the cases, we are asked to calculate the probability. Here, probability is used as an input and the output is getting calculated as a maximum loss. So read this statement. Within 1 day, the maximum loss is 20,000 and the probability of that maximum loss of 20,000 is 95%. Now, if I change the facts, the question asks me to calculate the maximum loss as 98,000. No, sorry, as 98% of probability. So can I say within 1 day, the maximum loss is, let's say, at 98%, the loss becomes 18,000. I am just assuming. Okay. So within 1 day, the maximum loss is 18,000 and the probability of this is 98%. You see, the moment you change your probability, your value at risk, the maximum potential loss is also changing. The moment I say the probability of maximum loss at 99% probability, it will become, let's say, 16,000 or any other number. Correct? Because I am coming closer to my estimate. And on the reverse side, can I say that within 1 day, the minimum loss is 20,000 and the probability of this is 5%. This is basis the level of significance. Okay, you tell me, if maximum loss is 20,000 and that has a probability of 95%, that means balance 5% probability has a chance that loss will be minimum 20,000. Correct? That is what I have written in the statement 2. Within 1 day, the minimum loss is 20,000. The probability of this is 5%. Within 1 day, the minimum loss is 18,000 and the probability is 2%. I am referring to this case that we discussed. Then 99% and 16,000. Within 1 day, the minimum loss is 16,000 and the probability of that is only 1%. You're seeing the same way to the two different ways to tell the same thing. I hope now your understanding is getting evolved, at least on the where. Now coming to the third concept here. Finally, I will link everything and then it will be fitting into your mind. Okay. Then third thing, returns from a security are normally distributed. So there is a concept called normal distribution that we are studying from our all the topics earlier. In Black-Scholes model also we discussed about normal distribution. What is a normal distribution? Normal distribution is this bell curved shape which equally distributes left and right. So if I take a 50% cut here, so let's say 0.50, sorry, this is 0, -1, -2, -3 like that, 1, 2, 3 like that. Here also 0.50, here also 0.50. It distributes in equal parts in mirror image. And the area under the curve is actually the probability. This is called as normal distribution. And this axis, x-axis, represents a z-score. Z-score is represented by x minus mean divided by standard deviation. This is a standard normal distribution. This we know. So this mean and standard deviation is actually computed for the series that we are plotting on the standard normal distribution chart. For that, we always need a z-score. Z-score is actually the x value for which we are trying to do the standard normal distribution. From that, we will reduce the mean and divide it by the standard deviation. Now, probability. Now, students, if you see, here we have to do the reverse side. So till now, students, we were actually calculating the probability using the normal distribution. Here we have to calculate the Z score because the probability is already given. As I told you, level of confidence is what? Probability. Using that probability, we need to calculate the Z score. And finally, now what is VAR, which is value at risk? That is the Z score multiplied by the standard deviation. So let me go to the Z table, just a second. Yes, this is the Z table. So students, from your earlier knowledge, we all know that the standard normal distribution represents the area from left to right of the curve. For example, this is the curve, right? This is left, and we are trying to calculate the value of, let's say 1.8. So 1.8 is here. So from left to right of 1.8, the value is 96%, 96.407%. This is area under curve, 96.407% till here. And this is a probability. Again, students, huh? Okay. Now, now in this, we are given probability. Probability is given, we have to calculate the Z score. If somebody says that 95% is the level of significance, where is 95 here? Let us search for 95. 95 is somewhere in between here. Correct. So this is 1.64, 1.65. So somewhere in between 95 is there. That means the Z score will be 1.64. Somewhere between 1.64 to 1.65. Okay. Now with this, we have arrived at Z score. We will put Z score here, which is using the table, and then multiply it with the standard deviation. Simple. Now Namrita is asking, what is the logic of calculating Z score? So Namrita, please refer to my detailed discussion on the Black-Scholes model, where I have explained why there is a need to calculate Z score. I will repeat it now also. But for the proper concept building, you refer that. Essentially, what happens that every series is actually denominated by two metrics. One is mean and second is standard deviation. So every series have this mean and standard deviation as one of their characteristics. Now, standard normal distribution have mean as 0 and standard deviation as 1. This is called a standard normal distribution. And this mean was, let's say, 2 here, and it was also 2.5. For example, I'm assuming. This is for some different series. And what series? This is a historical returns of that portfolio. Whatever portfolio we are talking about, for that we have taken historical return. Basis that historical return, we have calculated a mean and standard deviation. Okay. And on the other hand, I'm telling you that standard normal distribution have a characteristic where mean is always 0 and standard deviation is always 1. Now, if you have to convert this into standard normal distribution, what you will have to do is you will have to reduce 2 here and divide it by 2.5. Correct? This is called as Z score. Z score is nothing but converting the regular series into a standard normal distribution. Namrata, I am explaining the Z score again. You can listen here. Okay. So what is Z score essentially doing? Z score is converting the different series that have mean and standard deviation into a standard normal distribution where mean is 0 and standard deviation is 1. How it is converting? Because it is reducing the mean and dividing it by the standard deviation. So standard deviation essentially becomes 1 and reducing mean becomes 0. Correct. So once it get converted, then for that standard normal distribution, there is a table available that we have seen here. This table. This is for standard normal distribution. From this, we can calculate probability if we have Z score, or we can calculate Z score if we have probability. Anything can be done, vice versa. Okay. Since var requires Z score because we already have a probability, hence we take the Z score from var from the table. Okay. Okay, students, I hope now this is clear. One more point, for standard deviation, we have to take the standard deviation for the relevant time horizon. That means standard deviation for 1 day, 10 day, or any day. This is always we have to take in absolute amount. We don't have to take in percentages. This we have already discussed. Now, this is the way we can actually shift from 1 day to multiple days. For example, standard deviation, this is variance actually. Variance for 10 days is equal to variance of 1 day multiplied by t. T is equal to number of days, which is 10. So if we have 1 day variance, we can convert into 10 days variance. So standard deviation for 10 days will become variance of 1 day into t raised to the power 1 by 2, which is this formula. Okay. So var for t days will become Z score multiplied by SD for 1 day multiplied by under root t. So we are actually replacing this from this. Okay. And similarly, var for t days will be var for 1 day multiplied by under root t. Simple. Okay. Now, I have tried to explain this in another language. Portfolio value is 10 lakhs. Maximum loss computed basis var is 5,000. Level of confidence is 95% and time horizon is 20 days. So out of 20 days, in 1 day, expected loss to be 5,000 maximum. Correct? No, sorry. 20 days, 95%, 5%. 95% is 19 days. 5% is 1 day. Correct. So out of 20 days, 19 days, there is a probability that the maximum loss will be 5,000, and 1 day there is a probability that the minimum loss is 5,000. Okay. See, this is what I've tried to explain here. 90 days loss is maximum 5,000. 1 day loss is minimum 5,000. So 95% chance that loss is more than 5,000 in 20 days, but only 5% chance that loss is minimum 5,000 in 20 days. Okay, students? Then comes the questions. Sorry. Now, students, let us tie back this definition again and let us consolidate our all the understandings here. Value at risk. Value at risk measures the maximum potential loss in the value of a portfolio. Sorry. So the output, okay, let me do one thing. Let me write it in a fresh manner here. Measures the maximum potential loss. Okay. In the value of a portfolio for given period of time for given level of confidence. Now see here, students. Value at risk measures the maximum potential loss. This is the output of the financial model, correct? And all these are inputs. From the definition itself, we have broken it down, correct? What are the inputs required? First of all, the value of the portfolio. What is the value of portfolio? Then only we will be able to tell you what is the maximum loss. For which time period are you looking for? Because if time is equal to 1 and time is equal to 10, both of them will have different amounts. And what is the given level of confidence that you need? How much you want us to be probable? With what surety level you want us to give that number? In case you tell us that, okay, 95% you can be confident and you can tell us, then we will assume 95% as our probability and arrive at the Z score. Okay, students. And this is actually based on the entire standard normal distribution. Now, if you see, I mean, how Z score is also relevant. There is one more way to explain that. 20,000 maximum loss. 10 lakh portfolio value. Let's say these are given to you as inputs. Now I'm actually revising. I'm tweaking the inputs and outputs. Okay. I'm putting maximum loss instead of outputs into inputs. Portfolio value is also given. Let's say time is also given for 10 days. Standard deviation is also given as 2, for example. Then till now, the output expected from all of you was that what is the probability for this? Correct. So what we will do? We will first calculate the standard deviation and mean. Using that, we will calculate the Z score, which is minus mean divided by standard deviation. Then for this Z score, we will refer standard distribution table, standard normal distribution table. And then we will arrive at the probability. Correct? But here what we are asking to do is reverse. You take this as output and take this as input and calculate the Z score. Simple. And using the Z score, you arrive at the maximum loss. Because students, see, now formula, what we are doing in the formula? For var value at risk, we are taking Z score and multiplying it with the standard deviation. Now, what is Z score? Z score is divided by standard deviation. Correct? So ultimately, this is getting cancelled. You are seeing this. And it will help us in arriving at what we need. What is the maximum potential loss? This is the maximum potential loss. Okay. So Namrita is asking, SD is given for 1 day 10 days and we want it for 1 day, how to convert it? Simple. This one, these formulas we have discussed. Namrata? Namrata, we have actually covered this part. Yes, see, we have to just take a under root t and multiply it. Standard deviation of 1 day multiplied by under root t, which is under root 10, we will arrive at the standard deviation of for 10 days. Yes, standard distribution will be given in examination, Namrata, or they will give you the relevant extracts, basis which you can arrive at the probability or the Z score, which whatever you want. Okay. So with this, the value at risk topic also comes to an end. Again, we have did good amount of questions to explain this better. What I suggest is please go through the sessions, the recorded sessions in which the detailed discussion is also there. But I hope this incremental discussion on Z score, standard normal distribution, probability definitely helps you. And the entire revisionary part also supported you in terms of the query handling and the solving part. I would thank you, sir, for the opportunity. I would request the Ashish sir to help us with the concluding remarks and his comments.
Thank you, Devas. Thanks a lot. I think there are some issue in your health because
yes, sir.
Despite your bad health, you have taken the class. I really thank you for the same.
Thank you, sir.
Because you have put all the efforts.
Yeah.
Can you stop the screen sharing?
Yes, sir. Yes, sir. I will do, sir.
Yeah. Okay. Let it be remain. No problem.
Okay.
Okay, student. With this, we are coming to the end of the session of our. You can say that almost we have covered with our course. Our syllabus has been over now with this revision class, and in this session, one student was asking, sir, spin-off about the concept of. I hope Devas, you have made her clear. Can I quote her some example if you permit?
Yes, sir. Yes, sir. Yes, sir. Definitely.
Actually, recently, I don't know you have quoted in a class because I was not present at this time. Recently, Geo Financial Services has been spun out of the Reliance Industries Limited. And what happened last Wednesday, it has been spun off, and it was speculation was right. It was like that the price will be like say 160 to 180, but the price has reached 261.85. So now what happens from Reliance share price? How this price have been arrived? Actually, Reliance was trading somewhere around 2841.85. Okay, on Tuesday somewhere. On Wednesday, what happened? The Reliance Industries were trading at 2580, and the spun off share of the Geo Financial Services that has been listed, it is trading at 261.85. So difference is that. So by this, ultimately, what is happening? The shareholders of the Reliance Industry, each shareholder will get one share of the same. So ultimately, their wealth will be somewhere around the same. Only the difference is that they will get the share of a new company. So that is a called concept of spun off. Am I right, Devas, or you want to add something like?
No, sir. You're
okay.
That's correct only. Yes, sir.
So I want to just quote a recent example that have come to my knowledge.
Yes, sir.
And my pleasure. And now, student, in the forthcoming class, we are. I will conclude the whole. You can say classes over there. And one more important, I will distribute one assignment. I will upload one assignment before, in which I am taking some special questions that has not been covered under any topic, but normally they are asked in the examination. So I will discuss these questions in the class. So student, my request to you, please attend this class online, and it will certainly help you. And in this class, I will also discuss every type of your doubt. So student, in the forthcoming class, please, I request you to join the same. And Namrata, I think you was asking that, sir, whether the standard distribution table will be provided in the examination. Actually, it may be possible that it may be available, may not be available. I cannot sure that, but the extract will be certainly provided in the examination. And in case if it is not provided, somehow extract is not there, table is not there, so don't worry. Okay, wherever you can leave the question there. Don't get panic. If I don't have the value, then what will happen with me? So ICI will take care of this part. You not to worry about it, because IC assume that this table should be available with the student. In any case, if it is not available due to any reason, okay, so don't worry for the on that part. IC will take this care. So with this, I really thank CA Divas sir, your contribution to our classes, and because you have, and I really appreciate when you have made understood the where, then you are telling the Delhi to Mumbai. What is
Yeah.
that? This example is unique.
Correct.
So this is a one very good example.
Thank
Okay,
you.
sir. Thanks a lot for your time, and thanks
Thanks a lot, sir,
student for
for
your.
the opportunity. Thank you, sir.
My pleasure, my pleasure. And thanks student for your patience listening. See you in the next class. Okay. Have a nice day.
Thank you, sir. Thank you. Thank you all.